Today, we're diving deep into the world of income-generating investments. You know, the kind that keep that cash flowing even when the market gets a little, well, wobbly. We're talking bonds, REITs, high-dividend stocks, the whole gang. But with so many options, how do you choose the right one for you? Fear not, ETF explorers. We're about to break down the key differences between these income machines, so you can build a strategy that fits your goals. What's your favorite income-generating investment? Let us know in the comments below. Question 1. What is iShares Core Global Aggregate Bond UCITS ETF? The iShares Core Global Aggregate Bond UCITS ETF is an exchange-traded fund, ETF, designed to track the performance of a broad basket of investment-grade bonds issued by governments and corporations around the world. Here's a breakdown of its key features. Investment objective. The ETF seeks to mirror the returns of an index, composed primarily of investment-grade, high credit quality, bonds from developed and emerging markets. This means it aims to deliver similar performance to the benchmark index it tracks, after accounting for fees. Structure and management. The fund is passively managed, meaning it doesn't employ portfolio managers to actively select individual bonds. Instead, it holds a diverse pool of bonds that reflect the composition of the target index. The specific index it tracks may vary, depending on the ETF version, hedged or unhedged. A common benchmark is the Bloomberg Barclays Global Aggregate Total Return Index. The fund is rebalanced periodically to ensure its holdings continue to align with the target index's weightings. Benefits and considerations. Diversification. By holding a large number of bonds across various issuers and geographies, the ETF offers diversification benefits. This helps mitigate risk compared to holding individual bonds, as the performance won't be overly reliant on any single issuer or country. Low cost. ETFs typically come with lower expense ratios compared to actively managed bond funds. This translates to potentially higher returns for investors over the long term. Transparency. The holdings of the ETF are generally public information, allowing investors to understand the underlying composition of their investment. Liquidity. ETFs trade on stock exchanges throughout the day, offering investors a high degree of liquidity compared to individual bonds. Question 2. What is the expense ratio of the iShares Core Global Aggregate Bond UCITS ETF compared to similar ETFs? The iShares Core Global Aggregate Bond UCITS ETF boasts a competitive expense ratio, but it's important to compare it with similar offerings to determine how cost-effective it truly is within the landscape of global aggregate bond ETFs. Here's a breakdown. Understanding expense ratio. The expense ratio is an annual fee expressed as a percentage of a fund's assets. It covers the operational costs associated with managing the ETF, including O. Fund administration, O. Marketing and distribution, O. Underlying index tracking fees. Expense ratio of iShares Core Global Aggregate Bond UCITS ETF. The iShares Core Global Aggregate Bond UCITS ETF typically has a very low expense ratio, around 0.1%. This is considered quite attractive for a passively managed ETF offering broad global bond exposure. Question 3. How does the underlying index selection process work for this ETF? Does it prioritize specific regions or credit qualities? The iShares Core Global Aggregate Bond UCITS ETF tracks a specific bond market index, typically the Bloomberg Barclays Global Aggregate Total Return Index, BAL-TR. This index selection process prioritizes diversification across various bond issuers, geographies, and credit qualities, but with a bias towards investment-grade bonds. Here's a deeper look. Index selection process. The ETF doesn't actively select individual bonds. Instead, it replicates the holdings and weightings of the target index, often BAL/TR. The index provider, in this case, Bloomberg Barclays, establishes a methodology for selecting bonds that meet specific criteria. BAL/TR index construction. Market capitalization weighting. The index primarily weights bonds based on their market value. Bonds with a larger outstanding issue size will have a greater weight in the index. This ensures the ETF reflects the broader market composition. Investment grade focus. The index predominantly includes bonds with investment grade ratings, BBB or higher by SP or Ba3 or higher by Moody's. This prioritizes creditworthiness and aims to mitigate default risk. Geographic diversification. The index incorporates bonds issued by governments and corporations from developed and emerging markets around the world. This provides exposure to diverse economic conditions and potential returns. Maturity spectrum. The index holds bonds with varying maturities, offering a balance between potential income generation and interest rate sensitivity. Regional and credit quality considerations. While diversification is a core principle, the index will naturally reflect the current global bond market landscape. Developed markets like the US, Japan, and Europe typically hold a significant weight due to their larger bond markets. However, the specific allocation can fluctuate over time. The index prioritizes investment-grade bonds, but there might be a small allocation, usually less than 5%, to high-yield, below investment-grade bonds to capture some additional potential return but also introduce some credit risk. Benefits of index selection process. Diversification. The index approach ensures the ETF offers broad exposure across various bond segments, mitigating concentration risk. Transparency. The index methodology is publicly available, allowing investors to understand the selection criteria and potential biases. Passive management. By tracking an index, the ETF avoids the complexities and costs associated with active bond selection. Question 4. Does the ETF employ any hedging strategies to mitigate currency fluctuations? The iShares Core Global Aggregate Bond UCITS ETF offers two main share class options to address currency fluctuations, hedged and unhedged. Understanding the hedging strategy employed in each version is crucial for making informed investment decisions. Unhedged share class. This is the more common version of the ETF. The fund itself does not actively hedge the currency exposure of the underlying bonds. The bonds within the ETF are denominated in various currencies, including USD, Euro, JPY, and others. The performance of the ETF will be directly impacted by fluctuations in exchange rates between the investor's home currency and the currencies of the underlying bonds. This can be beneficial if the investor's home currency weakens against the currencies of the bonds held within the ETF. However, it also exposes the investor to potential losses if their home currency strengthens. Hedged share class. This version of the ETF employs currency derivatives to mitigate the impact of foreign exchange fluctuations. The fund manager uses instruments like futures contracts or currency swaps to hedge the exposure of the underlying bonds to a specific currency, typically the investor's home currency. This aims to deliver a return that reflects the performance of the target index in the investor's home currency, regardless of fluctuations in other exchange rates. While hedging can minimize currency risk, it may not completely eliminate it. Additionally, using derivatives can introduce other potential risks, such as counterparty risk, the risk of the derivative counterparty failing to meet its obligations. Choosing between hedged and unhedged shares. The decision of which share class to choose depends on your individual circumstances and risk tolerance. For investors seeking exposure to the global bond market without currency concerns, Choose the hedged share class if you want your returns to primarily reflect the performance of the underlying bonds and minimize the impact of exchange rate fluctuations. This might be suitable if you have a short-term investment horizon or a preference for stability in your portfolio. For investors comfortable with some currency risk and potentially benefiting from favorable exchange rates, choose the unhedged share class if you're comfortable with potential currency fluctuations and believe the investor's home currency might weaken relative to the currencies of the underlying bonds. This approach might be suitable for investors with a longer-term investment horizon and a tolerance for some currency risk. Question 5. What are the liquidity risks associated with buying and selling this ETF? The liquidity risks associated with buying and selling the iShares Core Global Aggregate Bond UCITS ETF are generally considered relatively low, but there are still some factors to consider. High overall liquidity. ETFs, by their nature, trade on stock exchanges throughout the day. This allows for a high degree of liquidity compared to individual bonds, which can be more challenging to buy and sell quickly. The iShares Core Global Aggregate Bond UCITS ETF typically has a high trading volume, further enhancing its liquidity. This means you can generally enter and exit your investment position with relative ease. Potential liquidity concerns. While the overall liquidity of the ETF is good, there might be situations where liquidity becomes a temporary concern. Market volatility. During periods of high market stress or economic uncertainty, trading volumes across all asset classes, including ETFs, can decline. This might make it slightly more difficult to buy or sell your ETF shares at your desired price. Large order size. If you're looking to buy or sell a very large amount of ETF shares at once, it might be challenging to find a counterparty willing to transact at the prevailing market price. You might need to accept a slightly less favorable price to execute the trade. Underlying bond liquidity. Even though the ETF itself is liquid, the underlying individual bonds within the ETF might have varying degrees of liquidity. If the ETF needs to buy or sell a large quantity of a specific bond to maintain its portfolio alignment, it could face challenges if that particular bond has low trading volume. Question 6. How does the ETF handle corporate actions such as bond calls or coupon payments? The iShares Core Global Aggregate Bond UCITS ETF handles corporate actions like bond calls and coupon payments in a way that aims to track the performance of the target index it follows, typically the Bloomberg Barclays Global Aggregate Total Return Index or BAL-TR. Here's a breakdown of the process. Bond calls. A bond call occurs when the issuer, government or corporation, decides to redeem a bond before its maturity date. When a bond within the ETF is called, the ETF manager will typically sell the called bond in the open market. Use the proceeds from this sale to reinvest in a new bond with similar characteristics to maintain the overall portfolio composition and tracking the target index. The reinvestment might involve a bond with a similar maturity, credit quality, and issuer profile to minimize disruption to the ETF's overall risk and return profile. Coupon payments. Bonds typically make periodic interest payments, coupons, to the holder until maturity. When a bond held by the ETF makes a coupon payment, the ETF will receive the coupon payment. This income is typically reflected in the net asset value, NAV, of the ETF, which represents the per-share value of the underlying assets. The ETF has two options for handling the coupon income. Distribution. The ETF might distribute a portion or all of the coupon income to shareholders as a dividend. This provides investors with a regular stream of income. Reinvestment. The ETF might reinvest the coupon income back into the fund, purchasing additional bonds to further grow the portfolio and potentially enhance long-term returns. Question 7. What are the long-term investment goals this ETF is best suited for? The iShares Core Global Aggregate Bond UCITS ETF can be a suitable investment for various long-term goals, but it's particularly well aligned with the following objectives. Income generation. The ETF offers exposure to a broad basket of income-producing bonds, generating regular coupon payments. These payments can be distributed to investors as dividends or reinvested within the fund for potential long-term growth. This income stream can be a valuable source of cash flow for investors seeking regular payouts, particularly retirees or those nearing retirement. Capital appreciation. While not a high-growth asset class, the ETF has the potential for capital appreciation over the long term. As bond prices generally rise when interest rates fall, the ETF's NAV can benefit from these long-term trends. Portfolio diversification. The ETF provides exposure to a diversified pool of global bonds, helping mitigate concentration risk associated with holding individual bonds. This diversification can contribute to a smoother overall portfolio return, especially during periods of market volatility. Long-term investment horizon. The ETF is best suited for investors with a long-term investment horizon, ideally 5+ years. Bond prices can be sensitive to interest rate fluctuations in the short term. However, these fluctuations tend to even out over longer periods, making the ETF a more appropriate choice for long-term goals. Here's a breakdown of how the ETF aligns with specific goals. Retirement planning. The ETF can provide a steady stream of income and some potential for capital appreciation, making it a valuable component of a retirement portfolio. Long-term savings goals. For long-term savings goals like education funding or a down payment on a house, the ETF offers a balance between income generation and potential for moderate growth. Risk-averse investors. Compared to stocks, bonds tend to be less volatile. This ETF, with its broad diversification, can be a good option for investors seeking a more stable asset class within their portfolio. However, the ETF might not be ideal for short-term investing. Bond prices can be sensitive to interest rate changes in the short term. Investors needing their money within a few years might be exposed to greater volatility. High-growth objectives. If your primary goal is aggressive capital appreciation, the ETF might not be the best choice. Stocks or other growth-oriented assets might be more suitable.